Good morning. Well, it's 12:02, actually. Good afternoon. Hi, I'm Lindsay Petrini, and I'm the Chief Operating Officer at Wellstar North Fulton Hospital, and proud to serve as the 2021 Chairman of the Greater North Fulton Chamber of Commerce. I would like to welcome you to our September Chairman's Circle Roundtable event. We are virtual again, so it is nice to see everybody on camera. As a reminder, on the Zoom call, the rules of the Zoom call, because we haven't gotten the hang of this yet. So please keep your microphones on mute so we can avoid any background noise during the presentation. If you have any questions, please use the handy chat feature. We will address questions at the end of the presentation. I would like to go ahead and introduce our sponsors for today's program. Our presenting sponsor is Sierra. Sierra provides industry-leading marketing intelligence solutions. And now Sierra's solutions are enhanced via digital advertising offered through Aeroscope and its own marketing advertising platform. Rory Robichaud, would you please say a few words as our presenting sponsor today?
Thank you, Lindsay. I appreciate it. And yeah, just very briefly, we are a digital marketing company and marketing intelligence. And right now, I'd just like to say one thing, that we're continuing to offer our services free of charge to nonprofits. So if you know of any nonprofits that need to do a more enhanced job of getting out the word in these critical times, please let me know. And thank you, Lindsay, and thank you, Wellstar, for what you do here as well. So I'll throw it back to you.
All right. Thank you, Rory. We really appreciate the investment. Our first event sponsor today is Herbert Legal Group. I would like to welcome John Herbert. Thank you for sponsoring our program today. And would you please say a few words?
Sure. Thanks, Lindsay. And thank you for the opportunity. It's great to be on with Rory and also with Josh Orkin, my neighbor here in Milton. So I appreciate everybody being here today. You know, commercial real estate plays a huge part in all of our lives. And I know everybody on this call knows this, but when I started to think about it, I mean, I've reviewed more commercial leases in the last 3 months than I have in the last 3 years. It's amazing to see the activity. Just got off the call with South African investors who are purchasing 3-4 new buildings. Just got that one done. So, you know, whether you have employees, whether your investment portfolio contains commercial real estate, whether you know it or not, it really touches everybody's life. And these days there's so many new considerations that are fluid and changing, and so very dynamic. It makes it more challenging for long-term planning for our businesses and our investments and everything else. So this is a really important topic that touches all of us, whether or not we think we're involved in commercial real estate or not. So we really appreciate this program today. Thank you for having us too.
Thank you, John. We appreciate your support. Our next event sponsor for today is Orkin and Associates. I would like to welcome Josh Barnes. Thank you for sponsoring our program today. Would you please say a few words?
Thanks, Lindsay. Glad to be here. I really appreciate the opportunity to be a sponsor for today. Looking forward to hearing what Greg has to say. As Lindsay mentioned, I work with Orkin and Associates, and we're a third-generation family-owned business that focuses on real estate investment and development. And right now, our pride and joy, our main focus, our big development is called Crabapple Market. It's the downtown area of Milton. You can check it out at crabapplemarketga.com. It's a really, really neat project. We're really proud of it. Right now we're finishing up the final touches on a stage for the green, which we'll be excited to bring some events to downtown Milton in the fall and in perpetuity. So that's it in a nutshell, and happy to talk to anybody if they have any questions afterwards.
Thank you, Josh. We appreciate your support. It is now my honor to introduce our keynote speaker, Greg Logan, the Managing Director with RCLCO. With over 35 years development and consulting experience, Greg has worked with real estate developers, landowners, cities and counties, private investors, builders, and legal and accounting firms. Greg's consulting work has included market and financial evaluations, fiscal impact assessments, economic impact evaluations, economic development strategies, valuations, and litigation support for a wide range of real estate product types. Greg, we appreciate you joining us today, and welcome back to the Greater North Fulton Chamber. We last spoke during the height of the pandemic, and we're looking forward to hearing your presentation and updates. Take it away.
Thank you. And yeah, RCLCO was formerly known as Robert Charles Lesser and Company. Our founder, Bob Lesser, was first an architect and then a developer, and who have had a lot of activity in the greater Atlanta area. I chaired the Atlanta District Council of the Urban Land Institute for some years there. And I'm pleased to be back with you. I'm going to try to share my screen here. See if that works. I can put some slides up. So hopefully you're seeing my screen now. Not if you can see my screen. So
Yes, it looks great.
okay, good. Thank you. You know, with PowerPoint, it sometimes it gives the presenter screen on there as opposed to the full screen. So I always get a little nervous that you're getting the right one. I'm going to share with you some excerpts from our second quarter chart book. We have RCLCO, where I sit. We're a real estate economics firm, and we do real estate economics in support of new developments and existing development. And we also have RCLCO Fund Advisors, where we are working with investors to place real estate. And once a quarter, we put together a report for the different funds that we help manage their investments, like CalPERS and CalSTRS and Alaska Teachers and Arizona State Retirement Systems, Alabama State Retirements, people like that are investing billions of dollars in real estate. And we try to focus on the long-term trends, certainly annual trends. We focus on the quarterly trends. I'm going to touch on some of the month-to-month changes as well. But what we've found is that we can either get overly excited or overly depressed by what's happening in a particular month. And so I am going to sort of look at the quarterly trends. And if you'd like, shoot me an email. Stacy has a copy of this presentation. If you'd like, shoot me an email and I'll share the quarterly chart book that will come out, I guess in October. We'll update this report with some of the slides that I'm going to share with you today. I have peppered this with some more some current August 2021 data. We're not far enough into September yet to know what the trends are. And even some of the August data comes out in mid-September. So stay tuned and I'll update that. But I'm going to try to focus on what I think are the long-term trends with what's going on in real estate. And I see somebody named Carter Barrett is in the waiting room and wanting to get in. Stacy, if you want to let him in. So, relative to commercial real estate overall, before I get into the slides, let me just say that the commercial real estate market is looking pretty good. Office really being the one sort of outlier of where things, from an absorption perspective or an occupancy perspective, still we're seeing some declines in occupancy and negative net absorption. Multifamily, industrial, and retail have seen some increases in occupancy. And I'm going off of CoStar data there, looking at some of the CoStar market data. In the apartment market, there seems to be positive net absorption. If we look at sort of the trend since 2020 through second quarter of 2021, and even third quarter, which we're still in third quarter technically, so we won't know what the full trend is until we get into the end of August. But as of sort of the mid-August, the 22nd, we have seen a decent trend for vacancy rates declining. On the office side at a national level, and I'm going to touch on some Atlanta metro area specific stats as well. But starting at kind of the macro level and very current, August data, and again looking at since 2020 second quarter, The office vacancy rate increased from about 9.8% to about 12.5%, and about 150 million square feet nationally of office space lost occupancy since 2020. So that's a big hit. And a lot of that, the reason it's still down, of course, is companies figuring out when they're all going to be, fully back in the office, and a lot of people still, working from home. At the peak of the pandemic, we had over a third of the market was still working from home. Those numbers have dropped into the teens now, but a lot of companies that had forecast they were going to, be back in the office space, full time after Labor Day. We know that changed for a lot of people, and so that's still having an impact. On the retail side, things are looking up. There's still some struggling going on there with standalone stores, and at one end of the spectrum. At the other end, looking at neighborhood centers, vacancies have crept up a little bit, but neighborhood centers continue to do pretty well. The industrial market overall, again, the most current month-to-month data, had about 500 million square feet of of industrial space get absorbed since second quarter 2020, and that more than offset the negative absorption in office space. When you look at commercial overall, vacancy rates, in industrial are pretty flat to low across most markets. We are seeing, in the manufacturing sector, some slowing and some new orders slowing down a little bit. Remains to be seen how that's going to affect industrial, but that's been somewhat of a bright spot. So with that, let me just kind of jump into some of the stats here. And again, nice little commercial on my firm there, which hopefully you'll read. It's short and sweet when you get a copy of this. But so I'm going to kind of follow what our more long-term trend to where we think the overall trends are. And again, second quarter 2021 for the economic outlook. I'm going to talk about the economy a little bit first, and then I'll go back to talking about the real estate market. Economically, we had a pretty good, after a huge dip in March and April of 2020, we did see GDP rebound somewhat, mostly by mostly consumer-led as people got out of that deer in the headlights moment of the initial COVID. And we saw the equity markets do pretty well. It looks like equity markets will continue to be pretty strong. There's some month-to-month fluctuation, of course. And I think we've seen a couple of days now in August of stocks being down a little bit. But overall, we think the bull market will continue through 2021. We think for the full year 2021, economy is going to grow, one of its strongest performances since the 80s. This has been, some people have called it the summer of Delta, and not our friends at Delta Airlines, but the Delta variant of COVID has had a big impact. But we think, fingers crossed, we're going to see another, strong above average year in 2022 as well, before long-term growth, starts to revert. Job growth has been pretty strong. Payrolls have been strong. We still have not fully recovered from the big dip that hit us in March and April of 2022, where we saw, big job fall off there. And we'll look at what segments of the economy that's been focused in just a minute. I shared some of that with you last time we're together, and I'm going to give you an update on that in just a minute here. There was the American Rescue Plan that gave a big injection, a big stimulus to the economy. That the impact of that's fading, but we think job growth is continuing to boost consumer spending. And now we have the investment, the Bipartisan Infrastructure Investment and Jobs Act, which reauthorizes some programs and puts about $550 billion into new spending. And one man's spending is another man's income. And that has tended to have a big impact when we've done that. That puts more dollars into the general economy. We are concerned a little bit about inflation overall. We've seen about 5.5% for the year. We think that's going to moderate, and that we'll be back to 2 or 3%. What we're putting in our pro formas, our real estate pro formas is 3% right now. Some are arguing now that could fall back to 2%, but but we have seen a surge in inflation this year. And we'll see, I guess, this week if Chairman Powell ends up getting reinstated. We think, interestingly enough, I think most people are forecasting that that maybe the growth in inflation will moderate in next year, and so that hasn't really translated into impacts on interest rates. So we hope that continues to be the case. As far as the U.S. overall, although we still have ground to be made up, as you can see on the chart, in terms of overall employment from recovering from the dip in March we expect that we're going to see a recovery there. The U.S. is still in an expansion. COVID-19 is still curbing a lot of economic activity around the rest of the world. That remains a threat. Employment growth was a little bit of a disappointment in August. Most economists saying that's was a Delta variant impact with caseloads going up in different places, and that plays out differently regionally. And we'll touch on how that affects us in the South. Where the big fall off was in leisure and hospitality. That's also been one of the sectors that's been slower to be able to see gains in growth. Pretty much all sectors were having a struggle in terms of gaining jobs back. The real exception being in finance. If you've got a job in the finance sector, you picked a winner. But professional and business services, while still not fully up, is doing a lot better than sectors like leisure and hospitality. And again, you see some noise, some month-to-month noise. And the stock market, of course, is not the economy overall, but it is something that we all look at, and you can see that the long-term trend in stocks is doing well. And Brandon, if you wouldn't mind holding your question until we get to the end, I'd appreciate it. Thank you.
Okay.
So as GDP, as I mentioned, GDP, took off, fairly strong, and in 2021, coming as a comeback from where we saw it go, through 2020. And you can see where our forecasts are for 2022. We're still expecting 2022 to be a fairly strong year. If you look at in comparison to other years, 2010, 2015, 2018, where we were, and we're expecting that we sort of get back to, quote, normal trend, 2023. And you're looking at where we think that how that falls out quarterly. We ended the second quarter pretty strong. We're seeing some fluctuation there as a result of the rise of Delta over the summer. We think that doesn't have a dramatic impact. We think that levels off over when we see the third quarter numbers. We think we'll see a little bit of a fall off. We think we'll have a stronger fourth quarter, and things will be pretty level and to up in 2022 and leveling off in 2023. Same thing, that's really driven by what's happened in the job market overall. We took a huge hit in 2020. We've regained a lot of those jobs, and so far in 2021, we think we'll see stronger gains in 2022, and then be kind of back to a more normal pace in 2023. And you can see how we expect that to play out. And then quarterly, those are actual quarterly numbers for quarter one and quarter two. And again, the quarter three numbers are not out yet. We'll put those out in mid-October in terms of where we think the long-term trend being. And again, what slowed us down over the summer and has been particularly strong in the southern states is the rise of COVID, and that has impacted industries overall. The biggest hits have been to leisure and hospitality. Eating and drinking places, were pretty hard hit over the summer, and that's partly because in some parts of the country there were closures, but it also has affected consumer behavior. That's probably been the biggest impact of where people kind of held off on what kinds of trips they take or how often they eat out, and that kind of thing. And that's true for us in Georgia overall. When we look at September 1st, 2020, where we had a couple thousand new cases, 7-day average, and then that jumped up to 9,000 new cases in the first part of September this year. And that is moderating consumers' behavior, and that's being felt in the economy. In terms of where that is, when you compare, I just have the data through August here. It's the latest available, but you can see that big impact on leisure and hospitality, which includes the sort of the subheading there would be eating and drinking places. Education and health services also impacted, and government impact. And then you start to get into professional and business services, and this is looking at how much we still have to regain and jobs and doing better. One of the categories that's big for the Atlanta region, with all the 85 corridor from Atlanta to the Carolinas and all the distribution and logistics and light manufacturing that we have there. You can see that sort of showing up in wholesale trade, pretty low numbers there. Transportation and warehousing, pretty low numbers there, which is certainly strong for the Atlanta region. This is looking across the board at what we think is where we think growth is going to be in the 2021 to 2026 period, and you can see Atlanta, they're somewhat in the middle of the pack. This is looking at average annual growth rate, and you do see some places out west and Texas that have bigger numbers, but Atlanta's kind of in the middle of the pack there with somewhere around 1.5% overall growth, and somewhere over 250,000 expected annual job growth on average. Not doing as well as some of the other areas, the Carolinas, Charlotte, the Dallas, LA, Houston, Denver, Austin, Phoenix markets, but doing better than some of the other markets and the Midwest and Northeast. In terms of real estate, I hit on this earlier. This is again pulling from our second quarter report. What we're seeing across the board, I shared some current stats with you at the opening here, but multifamily, we continue to see strong absorption. There's sort of perennial concern about pipeline and the multifamily sector, and but we still see pretty strong demand. And if anything, we think demand falling off a little, or new construction falling off a little bit. I'll show you market by market, and I have some current stats on Atlanta as well. We're still bullish on multifamily, bullish on industrial. Continues to have the strongest fundamentals of any property types. Office again is a challenge, and we have, I think, in the Atlanta metro area some 5 million square feet of office under construction. We have seen some gap between the Class A and the Class B, with Class A being a little bit harder hit. So there are some concerns there. Retail, continue to struggle somewhat with closed stores and some struggling tenants. Although consumers seem to be back, not fully back, but sales are rebounding. Certainly continues to be a lot of competition from e-commerce and retail, and I think long term we are seeing retail was already kind of a mixed bag. As we spoke about last time, even pre-COVID, with some retail space being taken up by growth in warehousing space, with online shopping continuing to be impacted, the retail sector. Hospitality sector has improved a lot since the last time I presented to you guys, and we saw a pretty strong improvement in the second quarter. And if we look at sort of the last month or so's data that's available, we can see that trend continuing, and we think business travel's starting to come back. Some resume leisure travel. Occupancy is up significantly from where it was pre-COVID, but there's still some hotels that haven't opened. I was in Chicago last week, and hotels that had announced they were permanently closing actually are reopening, and we're seeing that across the country. So that's pretty positive. We, as I mentioned, we're very active in the investor space, placing capital for pension funds and others. And we saw transaction volumes come up quite a bit in the second quarter, to 94 billion, up from 67 billion in the first quarter. And overall, year to year, transaction volumes are still down. Multifamily is still down. Retail is down most significantly. Industrial, being the strongest, and followed by multifamily. We are seeing a lot of dry powder out there, and by that I mean investment capital sort of on the sidelines waiting to come back into the market. Although some activity, significant activity with the 94 billion there. We have seen, the material and labor shortages, the supply chain impacts, which unfortunately we're probably not fully back from. We think that's going to be with us, into maybe mid 2022 before that really gets fully worked out, and that's had an impact. As with the massive layoffs that we had back in March and April, some people found other things to do, and particularly in the big hard hit in sectors like leisure and hospitality, some of those people probably are not coming back. So this is kind of our outlook looking ahead, and I think a lot of the second quarter status I've covered pretty well. So I'll just talk about where we expect sectors to go. RFA again is RCOCO Fund Advisors, where some of this material came from, and we expect long-term operating and investment performance in the multifamily sector to be very strong. We published a report which you can get off of our website, looking at suburban versus urban spaces. We've seen a little more weakness in urban spaces since a lot of the reasons for people to be in urban spaces evaporated with COVID. But we are seeing pretty strong employment growth. We don't think that urban suburban bifurcation is going to remain too long, and with the strong demographic trends and what we see as continuing strong renter demand, we're bullish on the multifamily sector. If you go to our website, you'll also see that we've written a lot about single family rental, which we're also very bullish on. We think we're just kind of addressing the tip of the iceberg in demand there. As I mentioned, it's kind of the uncertainty around return to work and office space, that and office usage continue to be down. We think that continues to have an impact. And again, then that sort of that suburban urban bifurcation that's been talked about a lot. We don't think that's long lasting. We think that we're going to see that level off between urban and suburban spaces. Although during the heights of the pandemic, we certainly saw stronger performance in the suburbs. But we think office is going to continue to struggle into 2022, unfortunately. Retail, absorption was negative through the first 4 quarters of the year. More recent data in the last couple of months, we have seen some improvement in retail space, although most of that is in the neighborhood space. The grocery anchored continue to be a fairly bright spot, and that's even when some people were not going to the store, you saw just a surge and Instacart and all that kind of thing, and I think that's fallen off now, and people are returning to shopping even if they're still wearing their masks. Industrial, again, we think that's going to outperform other assets well into next year and probably beyond. The most recent data we're looking at does show, as I mentioned, manufacturing and new orders falling off a little bit, and so we think that strong demand in industrial may moderate a little bit. We think in markets like Atlanta, which are so strong for light manufacturing and distribution in particular, that's going to continue to be a bright spot in the Atlanta regional economy. And as I said, we think that the business travel is starting to pick up. Leisure travel picked up already. Delta variant is causing people to change their plans for conferences and meetings. And I think as we all sign up to go to conferences, we're seeing that in our own lives, of where things at the last minute switch to virtual. And so we'll see how that plays out over the next year. That could impact hotel into 2022. That remains to be seen. But our best read of the tea leaves, it's a tough time to make predictions, because we made predictions about how we thought things were going to work out with rising vaccinations, and then vaccinations kind of plateaued, and that has had an impact on consumer behavior. And so we were predicting a different sort of summer than we've had. And so our best reading of the tea leaves is that maybe those hotel fundamentals stay depressed until at least May of next year, and sort of more mid 2022 before we see again more improvement there. This just gives us a look across commercial real estate sectors And you can see, where vacancies have gone, office there on the top of the chart, and the gray bars, by the way, that's recession. So you can see the 08, 09, and then the 2020 recession there. And you can see that in terms of, vacancy rates that affected the office sector to the greatest degree. Retail, we do see, vacancy rates continue to fall off as we, across the balance of 2021 and into 2022 and 23. We think apartments are still going to be just, very, very hot market there. And industrial, just kind of staying, strong and steady there. Multifamily, again, looking at the multifamily market, as I said, we're pretty bullish on that. We think that, we're not going to be too worried about vacancies. We think absorption, it will continue to be pretty strong there. New supply, I think we're not creating as much new supply as we probably need, and I think that's some conservative reaction to COVID that we saw. And our read of the market is that demand is still pretty strong. Rents, we did see decent rent growth this last year. Transaction volume could increase, has increased. We think there's room for transaction volume to increase, more strongly than it has. Wanted to just point out some current stats and point out some details about the greater Atlanta market. All of this data is MSA data, so green is good, red is not good. But if you look at where Atlanta is on the statistics, net absorption as a percent of multifamily stock, pretty good. Completions as a percent of stock, that's in red at 2.8%, but stronger than a lot of other places. You see that under construction as a percent of stock was about almost 11%, but you look at other markets like Washington, D.C. or Denver or Minneapolis or Austin, Texas, where it was up in the 20-25% or more. Atlanta is not that. And when you look at occupancy rates, 90, almost 93%. Year-over-year change growth, year-over-year asking rent change for the Atlanta metro area. Those are all really positive and suggest that Atlanta is a healthy market when it comes to multifamily space. On the office side of the market, again, as I said earlier, office vacancies are already high, still significant, still concerns about return to work. Absorption, was negative for the first half of the year. There is some concern about new supply, and as I mentioned, there's new supply coming in to Atlanta, and I'll touch on that a little bit more in just a second here. Rent growth really missing from the market. Transaction volume kind of not where we'd like to see it. This is looking at again the office, and you can see Atlanta there. Again, the good news on Atlanta is we are it's kind of, well, we're farther from the middle of the pack where we'd like to be. We're kind of at our long-term average vacancy rate. We'd rather be below that as we would be in a stronger market. So you can see that our current vacancies for Atlanta, bumping up on 15%, and right about where our long-term average is. We'd rather be down there with some of the tech markets like Seattle or Boston, or the Carolinas like Charlotte, which are doing much better. And so that is a bit of a concern there. And we do see a difference between Class A and Class B space. Where we think the U.S. office market is going overall, we do think we'll see more stronger recovery in the second half. Our reading of the tea leaves, we were expecting a lot of companies that had set Labor Day as kind of a target date for reopening. We do see that we have dropped from about a third of the market to maybe 15% of the market that's still purely work from home. We think that, as you can see on the chart here, that we will start to see rent growth in 2022 and continue into 2023, and that vacancies are peaking in 2022 and beginning to fall off to a greater degree in 2023, and that we will have positive net absorption in 2022 and 2023, which we think will exceed new deliveries overall. In the Atlanta market, we do about 5.5 million square feet coming on at the same time that that absorption has been not as strong as we like to see it. And so, office is going to be kind of not the brightest spot for Atlanta, kind of the opposite of what we think for industrial and multifamily. In the industrial space overall, again, this has been the bright spot in the market and a strong market for the Atlanta region. We think that, rent growth, we saw that kind of flatten. And in 2020, we're seeing that, ticking up now as we got into the end of the second quarter of 2022. And we think that I didn't show that, I didn't continue that line on the chart. I meant to show that that would continue to tick up in 2022. We think, vacancies are, even with a lot of net absorption, a lot of new deliveries, vacancies in the industrial space sector are staying flat, and that's clearly a bright spot for us. And then I have the disclaimers here that say your mileage may vary, and with that, I will pause and catch my breath and open for questions. Thanks for your attention.
Thank you, Greg. And I know we have some questions in the chat box, and I see Senator Beach has his hand up as well. So I do want to get to those.
Great.
Brandon, you were waiting patiently. You want to start?
Thank you, Brandon.
Yeah, I don't know how to do the chat box, so I'll just ask, you talk about inflation at 5.4%, I believe you said. And I just would tell you that I met with some peanut farmers a couple of weeks ago. They said their fertilizer was up 20%, their fuel costs were up 25%, their pesticides were up 20%, and their lumber and supplies were up 25%.
Mm-hmm.
And I can also tell you, just on a personal note, a year ago, I used to fill up my F-150 for $48. Monday, it was $85. So my question to you is, it just doesn't seem like inflation. It seems like inflation's higher than 5.4%, in my opinion. But I don't know how they arrive at that number. But
Well, a
I
couple
can tell
places
you
you can go. Yeah, so you can look at the conference board tracks that on a monthly basis, and that is that when you put everything together and on costs overall, it's I think 20% we might all be running for the doorways or converting our stock portfolios to cash or something. I don't think that's in the cards, and the latest as of this week is
well, I'm not saying it's 20%, but I can tell you, I think it's a little higher than 5.4% when fuel costs alone have went up tremendously. And fuel costs, I mean, they have an impact on everything we do.
Sure,
So,
yeah, energy costs are back. When you look at overall costs, probably the biggest growth in inflation has been in consumables, consumer consumables. Overall, the number's not mine. That comes from the conference board, which is the group that tracks that. You look at where the CPI is, check the Bureau of Labor Statistics and other people who track that, and that's the current figure. And if you look at what's coming out of the Fed, you'll see that one of the reasons why interest rates fortunately have stayed fairly flat, fairly stable, is the expectation coming from the Fed is that this is a temporary increase in inflation. So fingers crossed. We haven't seen that. I think if we were we really were at as high as 20%, I think we'd see that in interest rates, and certainly the Fed would be raising rates. Their expectation is I've seen forecasts for next year as low as 2%. That may be optimistic, but I think 4% or 3% is reasonable. I hope we're back to 3%, and that this 5%, 5.5%, proves to be temporary as the Fed has signaled. So fingers crossed.
Thank you. I appreciate it very much. We have another question regarding, and again, if anyone has any questions, please place those in the chat box and we will get to them. This one is about the commercial office statistics in Q2 2021. Occupancy and rental rates continue to decline. However, developers continue to deliver new office assets. You were just talking about that a little bit.
Yeah.
How much longer will the developers continue to deliver a new supply if demand continues to decrease?
That's a great question, and I think maybe some of those projects were started previously or in anticipation of us all being fully back to work. by now, and nobody expected the Delta variant to, and I think when a lot of forecasts were done, late last year or pre-summer, I think the expectation was that rather than 53% of the population being vaccinated, we'd be closer to 70%, and Delta would be less of an impact. So that is a concern. I think that it's a concern that's probably going to be with us into mid-2022 in the office sector. I think a lot of that has to do with how quickly we get COVID more under control and people do fully get back to the office. I think that unfortunately that's not the case, and as new deliveries come into the market, we are seeing some differences between Class A and Class B, with a little more pain in some of the Class A. Some of the Class B people, even if they've not returned to work, they're looking at it and saying, okay, well, maybe we'll be back to work and it's not as big a cost. And so it's not as big a pain point that they feel a need to go out and release space. I think, beyond that, I think it's important to, real estate's such a local thing, and to go in and look at the properties on an individual basis and see where are those properties. Are they in strong markets where there's not as much vacancy, or where a market has been underserved, and so forth. And to not say that I don't know that you can go from general market statistics to say that a specific deal is in trouble, but it certainly creates some context for thinking about that. And I'd certainly be concerned about delivering new space into a market where we're not fully returned to work, and where we haven't seen the absorption we'd like to see, and where rent growth has been flat.
Switching gears to look at retail, or to consider retail, we have someone who's posted, not heard much concern about employers hiring for the holiday season. Since they can't find workers now, won't they be in trouble when we get to fourth quarter?
Could be. Yeah, I think the retail sector, I think that the hardest hit sectors have been, as I pointed out earlier, just by a mile, has been leisure and hospitality, and including eating and drinking places. And and people who were employed in those spaces, in some cases found other things to do, and have also been resistant to being in roles where there's with the rise of Delta, where there's a lot of face-to-face interaction. And so that's been hard. Retail's been, a little bit more of an exception, not as hard hit as leisure and hospitality. And we have seen, I guess the context for that was, before we got into COVID, retail was already kind of a mixed bag. We had a lot of competition from online, and from quite frankly, distribution space, kind of last mile space, new Amazon warehouses, for example, being built in metro areas to serve that online delivery. And what happened with COVID? Well, next thing you know, you look around and everybody's getting packages. I noticed my neighbor across the street, has a FedEx drop box on their porch now permanently. So a lot of people doing that could be a work from home situation too. But that said, we saw the increase in packages really take off, and so that's been impactful. That said, we have had positive absorption in the retail space, and the picture has been a lot different than what we've seen in office. And we've seen, not the rent growth we like to see or the absorption we like to see, but we have seen positive absorption on retail. And I think we'll continue to see improvement in the retail sector. I'm more optimistic there than I am with office, and not to throw office under the bus entirely, but that's just going to be something that's going to be with us until we're really, fully returned to work. And that's probably not into next year, unfortunately. Retail, I think, will be a prettier picture.
Yeah, that's certainly, hearing from people that they've pushed back from the September and October even to January 1 of next year is, hard to swallow when you're a Chamber of Commerce as well, of course. So completely understand that. And I know everybody's trying to get back. I mean, that's the goal, right? We have another question regarding commercial lending requirements. To what extent have commercial lending requirements on commercial properties been affected by this pandemic?
You know, kind of, I guess the good news is there's a lot of capital out there. There's a lot of capital out there for good deals, both bank financing and private equity. And we've not really seen capital being a huge issue, but that it sort of depends on what kind of commercial property you're talking about. I think if you're talking about going out and borrowing money for a construction loan for a new office building with you know, still falling occupancies and you know, over 500,000 square feet, 500 million square feet of 150 million square feet. That was 500,000 growth in industrial last year and 150 million square feet of lost space on office. So some sectors are tough. In multifamily, we've seen no impact. I won't say no impact. Where we've seen impact has been in tertiary and secondary and tertiary markets. So if you're not in a strong suburban location or urban location, and you're in a secondary city within a metro area, we did see over the last year difficulty in getting construction financing and takeout lending, you know, from investors, either to build and hold or for merchant builders, you know, building and selling income property. We did see some location hesitancy, but in terms of the standards themselves or the availability of capital overall, not so much.
Very good, thank you. Folks, I appreciate all the questions. I know we're getting to the 10 till mark. I want to see if there are any wrap-ups. I see one final. Do you see COVID as a long-term catalyst, moving people and companies to more work from home approaches, or do you see the long-term growth of commercial office space as positive? This is your crystal ball moment.
I'll stick my neck out a little bit here, and I see the long-term growth of commercial office space as positive. I think, you know, I was an Atlanta resident for a metro area resident for over 20 years, and I know the developer mantra was, you know, please God, give me one more cycle. I promise not to screw it up this time. And you know, and I saw many booms and busts in the office sector, and we, the collective we of Atlanta, Greater Atlanta, we're good at seeing a good thing and building more of it and sort of overextending the market. I think that I think timing is really tough to peg, but I think that long term, I think, you know, the underlying fundamentals of Atlanta are pretty good. You saw in some of the charts I showed there in terms of where job growth is, you know, 250,000 a year, you know, annual growth is pretty good. I think the timing though, crystal ballish, you know, we're first or second quarter into 2022 before I think we see the turnaround there. And you know, the positive news, I think, heading into the summer of the Delta variant, we had seen vaccines sort of plateau, and I think a lot of people were kind of thinking, well, everybody's getting vaccinated, and why maybe I don't need to bother getting vaccinated because you know, that everyone getting vaccinated, things are going to fall off, and then we saw a lot of new infections over the summer, and it turns out fear is a pretty good motivator, and so, you know, I think we were at maybe 500,000 vaccinations a day pre-summer, and we're at about 1 million a day right now. So because of that, the good news, I mean, sorry, you know, sad to say that it took that, but I think the good news is we seem to be getting back on track. There's still some people who are vaccine hesitant out there, but I think, you know, again, I think that from an economic perspective, that's a positive that we're seeing that uptick in vaccines, and hopefully that will help us get things under control. And it's a wild card, as we've seen. You know, it's tough to say exactly how things will play out because we've all been wrong before. The real experts on the healthcare impact on the economy have been wrong. My read of the tea leaves again is I think we'll start to see positive trends by May of 2022, and hopefully by this time next year. And invite me back. Somebody write this down and invite me back next September. We'll see how right I was. You know, knock on wood, we'll see a positive trend in office by this time.
We'll look forward to a crystal ball check at that time. I appreciate it. Greg, thank you. I really appreciate your time today. You're always an informative presentation.
Thank
So
you.
much great data. It's really hard to digest all of that, but I think you do a really good job of synopsis at the end. So I do appreciate that.
Thank
I
you.
especially want to thank our presenting sponsor, Sierra. Rory, thank you very much. And our event sponsors, Herbert Legal Group and Orkin and Associates. Thank you, John and Josh. We appreciate your involvement in the North Fulton community and in our chamber specifically. The GNFCC Chairman Circle is an influential part of our chamber. We value your partnership with us. Our next Chairman Circle exclusive event will be held on October 13th at the Standard Club, and we'll focus on workforce development. Also goes hand in hand with the presentation you just saw. More details will be sent in a calendar invitation coming from Stacy Garman. We will look forward to seeing you in person at that time. I hope you all have a great day. Thank you.
Thank you all.